Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into, more of a discussion, further discussion on Washington policy. There's a lot of tensions that are persisting, so the theme of today's discussion is about that, policy tensions persisting, but also the implications in terms of the economy and the markets, which we'll get into. A lot of things going on, right? So let's jump into it. Maybe start just with a refresh of the kinds of changes that we've seen out of the Trump administration. We know about tariffs and trade policy. There's a tax bill, the reconciliation bill, sort of making its way through Congress right now. And so that'll have an influence on tax policy and fiscal spending. We know there's been some effort for efficiency around the Department of Government efficiency, big changes in health and human services and immigration policy and the Department of Education and a bunch of other places too, right? So really a significant set of changes that has increased uncertainty, which has been sort of a topic or a concept that has really shaken the market. And in fact, when we framed up our outlook for 2025, we had a couple scenarios, a bear case scenario and a bull case scenario. And in certain ways, while we've seen some market recovery, our bear case scenario concepts have unfolded a little bit. So right at the top of our list was the idea of erratic policy shifts and poor communication eroding animal spirits. So that concept of emotion in the economy and in the markets for investors, where there's an underlying, almost like current of optimism that can be shaken in these kinds of more uncertain times. There's worry, although most forecasts don't call for it, there's worry about the potential for a recession, for that recession to go global. And if you couple that especially with still elevated inflation, you can be in a stagflation environment, so weak or negative economy, probably think recession, coupled with high inflation. Those things don't typically go together. And so that would be a particularly negative environment. We don't think that's unfolding. We actually don't think a recession's unfolding. We have seen animal spirits get eroded. And so there's been this big focus on policy. We're very blessed to have Brian Gardner, Stifel's Chief Washington Policy Strategist. And, he does a lot of good work kind of unpacking what's going on. He's certainly been publishing a lot around trade and tariffs. He's been publishing a lot around this bill that is making its way through Congress. It's going to take some time. So again, we'll see how all of that unfolds. I did want to highlight, though, the elements in some ways of our bull case scenario. So this is the idea that despite this uncertainty, we see, a decrease in regulation, so more deregulation. We see tax reforms that keep or bring corporate taxes lower, and in some ways individual taxes lower, being both sort of a positive, making people feel a little bit better. That could kick up business activity, M&A activity, and ultimately, for example, more business, let's say, for traditional energy, that kind of thing. Couple that, by the way, with improved infrastructure and the need for better infrastructure, and there's going to be sort of allocation of spending that most notable would be all the infrastructure needed for artificial intelligence. So there's still these underpinnings of potential change and activity almost that would sort of bring back to the surface the idea of American exceptionalism and optimism ultimately driving markets higher. But we're a ways off from that for sure. But we'll get into some data on the markets. Now, when it comes to the economy, it's remind ourselves that GDP in the U.S. is comprised of a little over 2/3 consumption, meaning the consumer. But in this last reported number, first quarter GDP, the first estimate of first quarter, there was basically a negative print. It was down 0.3%, but notably there were two countering forces in that calculation related to tariffs. The first was a huge jump in imports. So think of it as people trying to import things in advance of the tariffs. And essentially that change in imports is a negative headwind on GDP. On the flip side, businesses really building up their inventories. That's actually a positive for GDP. Once again, with the view being that that was done to get certain things done before tariffs were enforced. So anyway, all that to say that the number was slightly negative. I think importantly, back to the idea of the consumer's role, the consumer's growth for the first quarter is estimated at 1.8%. So a little bit lower than what we saw last year, but still pretty healthy, right? And so that's something that people are anchoring on, is the consumer remaining active. They actually, sentiment and confidence are eroding a bit. We're seeing things like an increase in cost of debt. No surprise, given interest rates are higher, and we're seeing a decent job market, but all of that sort of adds up to worry, but still activity, still spending. Retail sales in the most recent report bumped up a little bit, so we're seeing the consumer remain engaged. And speaking of confidence, we do track a couple business confidence measures. One is the NFIB, Small Business Optimism, and then another is the CEO Confidence Index. And the punchline here is that they have come back down to basically a point of neutrality. There was some optimism in the wake of the election, thinking that the Trump administration would be business friendly, but with all the uncertainty, that's all kind of come back down to at or slightly below sort of a neutral level. And so that's an important thing to keep in mind. All of that to translate to, hey, at the end of the day, when we look across the industry and look at how firms are forecasting growth for 2025, growth has come down, meaning the forecast for 2025 growth the consensus when we started the year was 2.1% growth rate. That consensus has fallen to 1.4. So, for example, our colleague, Dr. Lindsay Piegza here at Stifel, has reduced her forecast for the full year of 2025 to 1.4%, right in line with consensus. And that's really kind of bringing it back from what was a much more positive number. So anyway, I think the punchline is most are not forecasting a recession, but a slowdown in the economy a little bit. One piece of research actually that Lindsay did, which is notable, is a study that demonstrated that there's been a slowdown at U.S. ports, and that obviously relates as well likely to the people pausing around worries about tariffs. Now, with all of this, so think of it as a positive economic environment, even with the Fed keeping interest rates higher, and the idea that tariffs and the trade policy could reignite inflation. Basically, the Fed has stood pat where they are. They're worried. They're talking about the uncertainty and worried about inflation resurging. But notably and importantly, when we look at the actual reports for inflation, notably CPI and PPI, the last 3 months have averaged levels well below the Fed's 2% target. The most recent readings in line are much lower than that in the case of PPI. And yet when we look at expectations, so the one-year break-even rate that reflects investors' views, the number is 3%. When we look at the consumer, there's one index that sort of looks at a 5 to 10 year view, and the average is 4.6%. But notably, when we look within that at parties, Republicans actually see inflation cooling down to 2% over the next 5 to 10 years, whereas Democrats are really worried and they are forecasting something above 5%. So again, just the broad takeaway is there's an expectation for higher inflation, but the recent prints have been good. All that to translate to the market now pricing in just 2 quarter-point cuts in the Fed funds rate between now and year end. So fewer than were anticipated just a few months ago. We know that all translates to the Fed having to try to optimize its dual mandate. So stable prices get inflation down while, quote unquote, maximizing employment. Now, the good news is, again, that the labor market is held up and the economy is held up despite the tighter monetary policy that the Fed has in place. So we think the Fed, anyway, will indeed stay slow in terms of cutting rates. They're very much monitoring the activity, monitoring for inflation, and they're just going to pause and wait for a while in our view. And so we're, again, as we've talked about before, probably thinking 1 to 2 cuts this year. Now, all this, as we've talked about before, relates then to an interest rate environment that remains elevated compared to certainly what we were seeing since the financial crisis, and especially since or during the pandemic. So the 10-year Treasury, round numbers, is around 4.5%. The 30-year has bumped up above 5. The forward rates on the 10-year are ranging in the 5 to 6% range. So there's just this undercurrent of an expectation of higher interest rates. And when you couple that with a buildup in debt across the economy, households, corporations, but importantly the government, especially since the financial crisis, basically everybody's coming into this recognition that we've got a lot of debt, the cost of that debt's going to go up. And so, for example, in the current state, when you calculate the interest cost in our government budget, where you include the discretionary spending plus the interest cost in the denominator, basically, if we think of all of that as discretionary spending, it's a third of our discretionary spending. Actually, if you strip out that interest from the denominator and just say, hey, we've got to pay this, what does it look like relative to the rest of our discretionary budget? It's about half of what we spend on everything else. So it's a big cost, and it's going higher, right? So this is in focus. By the way, we saw a downgrade in U.S. debt by Moody's down to AA1. But honestly, that was after years ago, S&P downgrading to AA+, their equivalent level, and Fitch downgrading in 2023 to AA+. So it's sort of like Moody's did this, but they were the third of the three to make this move, and they're signaling these concerns around the deficit, the debt, and the cost of debt. But I've been telling clients that level, AA+ or AA1, whichever one you look at, is still a super good quality of credit, right? So there's not this urgent sense of default, but at the same time, as credit levels come down, investors expect to get paid more. That will have an upward pressure on treasury yields and sort of interest rates within our environment. So that leads us to the market. So we do see interest rates elevated. I mentioned 4.5% on the 10-year and over 5 on the 30-year, and that means as investors, when we look out to invest, there's some very appealing rates to invest in terms of putting money to work in fixed income. That said, it's been a little bit more volatile in the bond market. You have to be ready for that. And then on the equity market, we've seen this interesting pattern where when we look historically, much of the time, the average return of over the first years of a presidential term are generally positive. 2017, the first year of Trump 1.0, was super positive. This year, we saw a big decline looking at the S&P 500 from peak down, basically a drop of 19%. The good news is year to date, we've recovered to being almost even, and we've made a good amount of that drop back, right? So there's been obviously some worries about tariffs, then the pause, and then some deals getting negotiated. And so the punchline is that there's a little bit more relief embedded in the equity market, but every turn, especially if there's jarring communication in terms of policy out of the administration, the market can turn down for sure, and we're seeing that day-to-day volatility. To give us a sense for where we are, if you look back to the recent close, or if you look at the recent close on the S&P 500, for example, and you look back to when that close was a record, so think of it as a market going up and we were going to celebrate that record, it's really just back to October, right? So, if you think and ask yourself, how did I feel about market levels back in October? People were feeling pretty good. And so even though we went a little higher from there and then it went down and then it's recovered, the punchline is that so far the erosion hasn't been all that significant. It does translate to, therefore, the cap-weighted market being at a premium on a PE ratio basis, but the equal weighted market actually showing on average a slight discount in valuation. Now, I think another thing to note is that earnings have held up better than expected. So the first quarter year-over-year earnings growth is tracking to come in that growth rate at 13.5%, significantly higher than what was expected as we started the year. And all that means is, again, we're back to a level where the S&P 500, for example, year to date is, you think just in round numbers, about even. It's plus or minus based on day-to-day volatility. And for example, over the last year, that index is up over 11%. So again, when we look at a slightly longer period of time, the market's been pretty positive. And as I've mentioned, the idea of a broadening market, the equal weighted index is outperforming that cap weighted a little bit here in 2025. We've seen a weakening in the dollar that's helped non-U.S. Investments a little bit. But again, back to the idea of talking about patterns in performance. We did pull out again in a study that we've talked about before. How often do we see a 5% or more decline? That happens a couple of times a year. A 10% or more decline in the S&P 500 happens about every year and a half on average, importantly. And then the kind of classic bear market, 20% or more, happens about every 6 years on average. So we do see the pattern where, hey, we're going to see a lot of calendar years end up positive, even though during the year, in every year, there's a significant sort of downdraft in the market, right? So we see volatility, but we have to ride through it to get to the full year. And then we have continued to update our study as relates to the performance. And when the market goes down a lot, we happen to do one study where it's every time the S&P is down at least 15%. We'll take a look at both the recovery over the subsequent 12 months and the period of time it takes for the full sort of decline that was experienced to be recovered. And the bottom line is the data reinforces the idea that for long-term investors, it's pretty important to remain invested, because when that turn occurs and the recovery occurs, it can happen dramatically and it can happen quickly. So just to close out, just remind folks, when it comes to looking forward, we remain very focused on long-term themes: technology innovation, artificial intelligence, strategic resources, demographics, new consumer patterns, and the idea of productive competition, mostly these days, a keen focus on U.S. and China. And always, as I do, I invite people to go to stifelinsights.com to check out our work. Really, really appreciate you taking the time to listen to this episode, and we'll catch you on the next one.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.